given the concern with it. It's already been hovering around its record low. And that's something I've been speaking to Somnath Mukherjee for the last 2 months about. He's the CIO and a senior managing partner at Ask Private Wealth. I remember we spoke last time 2 months ago, Somnath, and we started the conversation with the rupee. So I want to start with that once again, because the rupee hovering around its lowest, we spoke about it last time as a shock absorber is what you called it 2 months ago. But you said it was great that the market was being allowed to find a level rather than the RBI's defense impacting that. You also said it was the best time to let the rupee depreciate. So much has obviously changed since then. Are you now worried for the rupee?
As of this stage, Amitoj, not really. I think rupee will reflect the fact that India imports, as you mentioned, a very large part of its energy requirements, both in terms of hydrocarbons as well as in terms of critical fertilizer inputs as well. And therefore, if that reflects in the rupee for now, it continues to be the shock absorber that we spoke of a couple of months ago. It's rather better for the central bank to use this opportunity to let the market determine the level of the rupee and also build in for the longer term some level of currency related competitiveness of the currency, given that Chinese yuan is holding up quite well, instead of trying to defend the rupee. Right now, the focus should be elsewhere, not in terms of managing the rupee dollar level at all. Though must say that RBI has been very smart in the last couple of weeks navigating this whole war-related disruption in the market, both in the currency market as well as in the bond market. They've ensured that volatility is managed, but no levels are targeted, and that's the way it should be. Right now, the focus should be on managing volatility, managing the uncertainty, rather than defending levels, whether it's of rupee or of bond yields.
I want to talk to you about the double squeeze India is facing right now. Oil import bill surge because of the war and potential export tariff threat. Section 301, new developments coming in that would expand that investigation to 60 countries. You already had 16 countries announced yesterday. What does this compound macro scenario mean for the rupee, the current account deficit, and obviously, particularly India's credit rating trajectory in your view?
I think there is a risk of us falling too much into the gloom and doom narrative here because remember, India is coming off a really nice base while it confronts this crisis. The current account is in fairly good shape. Last print of current account was roughly about 1% of GDP. That's sort of the very ideal level that macro policymakers have been advocating for a very long time. So I don't think there is such a gloom and doom prognosis that we need to jump into. India is a lot better prepared to confront energy crisis of the sort that we are seeing today. And we've seen similar McCoy happen over the decades several times before. This could be probably the most acute one, but certainly not the first one. And India today is a lot better prepared than any time in living memory to confront this. So I don't think we need to jump into a gloom and doom scenario just as of now. External accounts is fairly robust. Foreign exchange reserves are actually quite good. Buffeted by the fact that RBI, like many central banks around the world, had increased share of gold in its reserves, and revaluation of gold in the last couple of years have also buffeted FX reserves quite a bit. So all in all, I don't think there is time or there is any case to panic just yet.
All right. I just want to quickly talk to you about a little bit about the USTR, and it's another investigation now under 301 on 60 economies, the forced labor probe, particularly aimed at textiles and minerals. And I just want to understand what you think about that in terms of India-specific exposure, what this could mean for Indian industries.
Yeah. Yeah, so Amitabh, I think this is going to be the new reality. India is not the only one singled out, as opposed to the Russian tariff sign that was there till a few weeks ago, where India, alongside China, were the only two countries lumped with that tariff. This is an investigation that encompasses a very large swathe of countries. I'm sure there'll be enough conversations going on at the back end trying to resolve this. But it is a fact that the new normal globally on trade is that it is a function of geopolitical bargaining and negotiations. And these will increasingly be bilateral in nature instead of the old or 3 decade old multilateral normal that we've been used to. India has been quite smart. The last few months, the country has entered into free trade agreements with a swathe of very large trading partners from Europe to UK to Australia to UAE. So various bilateral FTAs have been put in place to diversify the trade basket as well as build newer plugins into global supply chains. So this new investigation by the USTR is part of the new normal. It will require negotiations, and most likely it will get resolved on the geopolitical chessboard as a quid pro quo on something else instead of a technical discussion on tariffs or protection on bilateral basis.
Yeah, but that could take time. And I guess the point out here is that there'll be an overhang on the sentiment on Nifty. And in that context, there's also the Iran war, the LPG crisis, which has now triggered the Essential Commodities Act invocation. There's price controls happening. There's supply rationing happening. Let's get specific and talk a little bit about what that means for OMC stocks and perhaps India's fiscal arithmetic for just FY27.
Right. So while I won't be able to comment specifically on stocks, usually the oil marketing companies right now will be facing a bit of a squeeze because oil prices have gone up. And while pump prices haven't been adjusted yet, hopefully this is a relatively short-term issue. Fact is, over the last few years, several of these OMCs have done pretty well because remember, one of the things that India has done is to build up a very large tax buffer on the pump price of petrol and diesel. And that sort of buffer enables the government as well as the oil marketing companies bilaterally to figure out a modus vivendi on how much of this increase in global crude is passed on to consumers and how much is absorbed by the fisc and how much is absorbed by the oil marketing company. So I think there is, thanks to the nearly 55% tax buffer in the pump price of oil, there is headroom there. Again, too early and in frenetic times, never a good time to jump into conclusions. So I wouldn't worry right now, or rather, I wouldn't panic right now on that count. From a broader equity market perspective, the markets, of course, are currently, like globally, most global markets are discounting the disruptions caused by the war. So is the Indian market. The Indian market has been on a bit of a consolidation mode for the last year and a half. That has been mostly due to internal factors, which is slowing growth and high entry point valuations a year and a half ago. I think that process is continuing and will continue till the time we see some clarity on how this war, the end game of this war is.
Right. I want to get in two quick questions with you as we run out of time. The first is an example of what's happening on the ground with LPG. Blinkit is selling out induction cooktops while Zomato's restaurants' orders are collapsing. And the parent company, Eternal, they're accidentally becoming India's emergency supply infrastructure. How do you invest in such a scenario? I know you can't speak specific stocks, though.
No, it is never a great idea to start making investment decisions basis situations like this, either to come in or to get out. I mean, these are extraordinary circumstances, extraordinarily volatile circumstances. So unless somebody is a trader, somebody is a very, very smart trader looking to make quick profits, not a great time to make decisive bets one way or the other. The only thing, and that's sort of the banal and the quotidian thing to say, is to stick to the discipline, stick to long-term plans, and move on with it. Ignore the noise, as they say. I would say it's a lot more value-adding for most investors today. Instead of switching on whichever terminal that they want to, or switching on whichever channel that is their favorite, but go to a concert or a movie. Probably a lot more value-adding today.
I just want to quickly get your point of view on NSE. The National Stock Exchange of India said on Thursday it has appointed 20 merchant banks to manage its long-awaited IPO. At the same time, it has regulatory history, which has been embroiled in litigation, and it's appointed several law firms. Should all of this give investors confidence in this IPO or anxiety?
Again, I wouldn't be able to comment on the specific stock, but from a domestic investor sentiment perspective, you just need to look at the data. Every month, mutual fund SIPs are hitting a new all-time high numbers. And that was true for last month as well. And I think by all indicative information that we get, this month looks no different. Domestic investor sentiment is resilient, is strong, buffeted by essentially three things: mutual fund SIPs, national pension scheme allocations, and employee provident fund allocations. I think that bit is the key buffer for the Indian markets, and domestic retail investor sentiment remains quite strong. So I don't see a problem on that ground yet.
Somnath Mukherjee, thanks so much for joining us. Really appreciate it. We're back in 2 with more market action. Don't go anywhere.